Welcome to XM.com for this special report. We'll be having a look at Q3 earnings season that begins this week. I'm Cristina Marujos, and joining me today is Cristina Barcenido, investment analyst. Cristina, we've seen stocks skyrocket to new highs in the first half of 2021, but there are worries that things are likely to take a turn for the worse now. Could we say this is just an expected correction after such a rally, or does it really paint a gloomier picture for the economic outlook?
Hi, Christina. Well, it won't be very surprising if we see less impressive corporate growth numbers coming in during the new earnings season because the unusual expansion during the previous quarters was an outcome of the comparisons to the dramatic decline some firms experienced during the harsh lockdown 2020 period. And of course, because of the massive stimulus provided by central banks and governments. So as the 2020 low numbers move out of the equation, the more normal and softer the new readings will be. And in my opinion, the Q3 earnings season could be an expected correction, but on the other hand, there are some ongoing risky developments in the business world which threaten a slowdown in the margins trajectory and keep sentiment downbeat. And those factors are higher input costs given the supply constraints in raw materials and the delivery delays which create the multi-year high inflation we face nowadays. Also, the employment costs could be another headache because business surveys, including the latest non-farm payrolls report for September, all keep witnessing shortage of qualified workers, which may result in higher wages in the near future in order to increase the labor force participation. So all these factors are expected to negatively affect guidance from businesses during the upcoming earnings season, which officially starts with US big banks on Wednesday. And besides the technical correction from base effects we mentioned earlier, production constraints and inflationary pressures are likely to be another reason why earnings estimates for the S&P 500 community have significantly diminished from August onwards, and according to analysts, are expected to keep trending lower at least until the second half of 2022 before improving again.
But as in any case where we have some benefiting from any situation, I suppose the same could be argued here too. Therefore, which type of stocks might struggle the most and who may appear to have gained the most on the recent developments?
Indeed, there are always some winners, even if that means surviving with little injuries. In other words, even if businesses appear somewhat cautious on average, some businesses could still perform better than others, providing some support under their stock prices. If we take the S&P 500 as an example, the tech sector was one of the best performers during the previous earnings releases. Companies like Amazon, Microsoft, and Apple were barely affected by the pandemic because of their flexible and modern business models, which saw extreme demand as business activities were executed through online platforms. However, that will not be the case anymore, and the tech sector could be more sensitive to downside corrections if companies downgrade their guidance because of their high valuations. Moreover, the tech sector has a negative correlation with US Treasury yields. So as Treasury yields move northwards, which is a signal of higher interest rates and therefore a signal that the value of their future cash flows will be discounted, tech stocks could be more vulnerable to any discouraging guidances. And now, which sectors could be better performers? I think the energy and utility companies, which see a significant increase in their prices nowadays and could see further boost during the winter season when demand for their products tend to strengthen. So those companies could be less sensitive to a discouraging earnings season. Also, the banking and financial industry could be another resilient sector given expectations of a tighter and monetary policy in the US and their strong positive correlation with US Treasury yields. And of course, after Evergrande's default risks in China, everyone will be interested to know how the US real estate and construction sector will perform in the coming quarters. Well, on that front, I don't think that we will have a China-style damage in the US. Definitely, house prices have been uncomfortably high between more demand and less supply since the end of 2020. But unlike the tech and semiconductor businesses, the US housing market is not very exposed to Chinese markets. Perhaps house builders may complain about the rising input costs and delivery delays, but given Biden's promising infrastructure plan, the low mortgage rates, and the elevated rents which motivate people to buy houses, I think the fundamentals remain overall positive for the industry. So to sum up, the next round of earnings releases may not show the record momentum previous reports witnessed, but probably some companies, I think, especially those in the financial and energy sector, could perform better than those who thrived during the lockdown period.
Cristina, thank you for joining me today, and thank you for watching the special report on the Q3 earnings season that kicks off on Wednesday here at XM.com.